Welcome. So in this video, I'm going to go over one of the other biggest objections to the buy, borrow, die framework, and that is the margin call. What happens if the stock market crashes and we get margin called and liquidated and the whole strategy is then null and void? So let's talk about it. So margin call. So the biggest thing to consider that people seem to forget is risk is a behaviour. It is not a financial tool. This is something that people seem to forget. We could give two people a margin account. One person blows the account up and gets liquidated, and the other person uses it responsibly and uses it for its intended purpose. So what is the actual reason people get margin called? The simple fact is they just borrow too much money. A lot of people seem to not understand the difference between investing and gambling. Some people genuinely cannot tell the difference. So I've made videos before on this, but I want to just show it with the actual numbers on the screen. In this example here, this person has a portfolio, a gross portfolio value of $2 million, and they're borrowing 20% loan to value. So that's a $400,000 loan. In order for them to get margin called, the stock market would need to crash, or their portfolio would need to crash 73%. Now keep in mind, in 2008 financial crash, the S&P dropped 57%. Yeah, so its worst yearly loss in history, 38.49% by the end of the calendar year. Ultimately lose roughly 57% of its value. So you're looking at 40%, 50%. So you would actually still survive a 2008 crash with a 20% margin loan. Yeah, there you go. So you start to understand that the margin call is happening to people that are just borrowing too much money. And as the portfolio grows, depending on your own circumstances, you should be able to borrow less and less, depending on what your actual financial requirements. So as you can see there, I've made a chart where after 75%, this person eventually gets margin called. So to put it into perspective, the portfolio is dropping from $2 million to $533,000. So the actual value. So a massive, brutal, aggressive crash. And this is just assuming this person has just got a basic portfolio. Obviously, it depends on the assets. If someone's got $2 million, in a penny stock, this then becomes probably likely to happen. But I'm just assuming the person is an intelligent investor. So you're surviving the 2008 financial crash in this situation. As the portfolio grows, we're moving into, so let's say what happens with a $20 million portfolio. Yeah. So let's look at that. So this person is now borrowing 15% loan to value. So the stock market would now need to crash 80% before their margin called. So their portfolio would have to go from $20 million all the way to a value of $4 million. Another massive objection I get, and I have made several videos on it before, is so how do we pay the loan? What do we do to pay the loan? How do we deal with the loan? The loan is also something that terrifies people. And it's very hard for me to sometimes just to break through the sort of the veil that people have on this. But when you see the numbers in black and white, you start to think, okay, let's have a look at this. I'm assuming this portfolio returns 7%. Okay, just very standard return. The assets are generating $1.4 million and the broker interest is $131,000. So there you can see it right in black and white. And imagine this. We have a choice. Do we pay down the debt or do we just buy more assets? Often when people see the numbers, they think, okay, well, I still can't justify paying this debt down. I would rather allow the assets to grow more and more. And another factor to consider with a margin loan is the interest is capitalised onto the loan. It's not something like a car payment or a mortgage payment or a credit card that needs you to actually pay into it every single month and pay capital off of it. The broker will just allow it to just compound against you. And that is why we obviously know that the assets must grow faster than the cost of the debt and faster than inflation, which again I've made several videos on. Now let's have a look at the upper end, where what happens if the portfolio is in the 200 million mark. This person can borrow 10% and their required market drop will be 86% before they are margin called. And at this level, these investors, what they tend to do is move away from the stock market and move into sort of private credit. The other thing to consider is, let's look at the actual cost of the debt. This is a broker that I personally use. So how do they calculate? How do they calculate the cost of the debt? Well, simply, it's the SOFR rate, which at the moment it does fluctuate slightly, but it's around 3.66%. And this broker will just add a credit spread onto it. And as you can see, the more a client borrows, the cheaper the debt. This then reduces their hurdle rate that their asset needs to outperform. That is why a lot of these larger investors will move into private credit. And I'll touch on that briefly, the private credit. So let's imagine the investor, their hurdle rate is now 11%. But also keep in mind, because they're funding it with their margin loan, they can effectively use a tax code to reduce the after-tax interest rate, so effectively can go down to around 2.6%. So their hurdle rate gets even less. So they move into private credit, these investors. So something called a mezzanine debt. So they look at a business and say, look, this business needs a loan. We will charge them, 15 to 18%. You might think, why on earth would someone accept an 18% loan? The business must have a terrible credit score. Well, that's exactly what we all think when we first hear about the mezzanine debt. But if you've watched my Shark Tank video, you know that the cost of equity, giving away equity, can be up to 900% more expensive than a bank loan. So who are these businesses and why do they need a mezzanine debt? Well, imagine the business has a fantastic cash flow, strong balance sheet, and its cash return on invested capital is nearly 37%. So it invests 6.5 million and it spits out 2.4 million. It's a fantastic cash flow in business, but it doesn't want to give up equity. So therefore, it wants private credit. So why can't it just go to the bank? So it goes to the bank. This company goes to the bank and says to the bank, right, I need as much money as you'll give me. The bank says, well, we're heavily regulated, but we'll give you, say, 2 times or 3 times your EBITDA, and that's as much as we can give you. You might also say, well, if the business is so good, why does it need debt? If the business has a CROIC of 36%, they want as much debt as humanly possible. Yeah, they want to take on as much as they can because the more money they have, the more they're able to turn it into free cash flow. So they will happily go to a private credit institution and take a loan out at 15 to 18%. And they know it's cheaper than equity. So that's where these investors are moving their money to private credit. So they're looking at these these institutions who their job is to sit and look at balance sheets and look for these types of companies, because it can be a win-win for both. Yeah, the company's printing money effectively because of their CROIC. That's why in a video I made before, this number is far more important than the profit and loss statement. And a lot of the analysts at these firms know that. You can also invest in private credit as well if you want. It's just a individual stock. You can see here this firm here is offering a yield at nearly 10%. And if you've watched any of my videos, you know that I say I wouldn't chase a company for a dividend, but it's different for private credit. They are legally obligated to actually pay out these dividends. It's their entire business structure. It's not like a stock, a growth stock, giving a suspicious 10% dividend. You know, everyone would be like, that's clearly a red flag, obviously. But these private credit, this is their entire business. So you can see there, obviously, the stock crash in 2008 and 2020. So you're getting credit risk with this, obviously. So you need to be mindful of that. And of course, depending on your tax bracket as well. But the most important part of this video is the margin call. How do we protect ourselves? You protect yourself by borrowing a conservative amount. And if the market does crash, it's about how much cash is in the broker account. How much cash is in the brokerage as well. You can deposit cash to protect the account as well. And we just don't over leverage. That's the simple truth. So 20% is my personal view. Every investor has their own appetite to risk. But there you go. Effectively, I don't necessarily worry too much about the margin call, because I don't personally think the portfolio will crash 75%. And again, that applies to people's assets as well. So people are invested in strong assets, strong companies, or even certain ETFs. It's very unlikely that the stock market your portfolio would crash past 80% before you can even put cash in. Let's talk about as well, while we're on the topic, a misconception that people have, a lot of investors have, is the difference between a margin loan and a Lombard loan, or a secured back line of credit. They're all different names for the same thing. A lot of investors think, well, if I have a private bank, then I won't get margin called, or they'll be more polite. They'll give you maybe a couple of days. And can they even match these interest rates? They could probably match it, and it would be like they'll be willing to take the loss on the loan they're giving you, but they're going to make the money up somewhere else, and that's through the asset under management fees, which I've made a video on before. But effectively, you're confiscating, or you're donating 30% of your lifetime wealth for the perceived safety of a bank. And fundamentally, a bank and a broker are two completely different business models. Yeah, so banks are obviously highly leveraged, highly regulated, and far more fragile than people believe. And a broker doesn't have any of the same sort of business requirements as a bank does. They don't have to meet any Basel III requirements, or they don't need to honour loans. And what I mean by that is any cash we have deposited in the bank is a loan to the bank, which we can pull out at any time we want. And that's how Silicon Valley Bank crashed, I believe. Yeah, let's look at that. Yeah, so there you go. It was largest bank failure. See, what all happened is everyone decided to do a bank run. They pull out their money, 42 billion in a single day, and it was liquidated. Yeah, a brokerage just doesn't have the same business model. A prime brokerage. So it's up to yourself where you wish to use this strategy. Everyone has their own preferences, but the cost, if you're building your house on sand, the foundation is so important when you are using the strategy, because you need to be aware of hidden costs and hidden fees, and these can add up over time to unbelievable numbers. So there you go. That's how we protect ourselves against a margin call.